Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at three highly ranked Zacks stocks to consider buying before their upcoming earnings releases. And those three stocks are Stride, NFLX, and Fastenal. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these three stocks, I quickly just want to go over where we are in the market at the moment. So the S&P 500 and the NASDAQ posted solid midweek gains after stalling out a bit on Tuesday. They had that big bounce back on Monday ahead of that highly anticipated CPI release Thursday morning. So I'm recording this Thursday afternoon. And the CPI data came in slightly hot. If you looked at the projections, people should have known it was going to not look necessarily the best, but it came in not crazy above expectations, just slightly above kind of on all levels. So month over month, core, headline, all of that came in slightly hot. So not the best sign for investors on their interest rate expectations, but the market was only down slightly as I'm recording this in kind of mid-afternoon on Thursday. So now the next big thing the market will be paying attention to is what we're talking about today is earnings season. So JP Morgan and the big banks unofficially kick off earnings season tomorrow, so Friday morning, and then kind of we just get rolling. So with that in mind, we're going to take a look at, as I said, three highly ranked Zacks stocks. And the first one up is Fastenal, which trades in the ticker FAST, so FAST. And the company reports its fourth quarter earnings results on Thursday, January 18th. So the company is a wholesale distributor of industrial, constructed, safety products in a range of everything kind of from electrical supplies and traffic cones to beyond. So if quickly just going over a lot of their different product categories, they have safety, janitorial and cleaning, tools and equipment, cutting tools and metalworking, various things, electrical, goes on and down the list. So their various distribution delivery methods include kind of industrial style vending machines. That is actually a thing. Bin restocking programs, and they have roughly 3,400 in-market locations. Many are branches, and then there's customer-specific on-site locations, as I mentioned, and they're spanning across 25 countries. So the company has rolled out far more tech and software-based solutions for its customers as part of its efforts to dramatically improve efficiency. Plus, its product diversity means that it's able to have a wide range of customers. And it's also less susceptible to the broader boom and bust cycles that some of these industrial and construction related companies deal with, because they're not selling these massive big ticket items. Instead, they're selling smaller components that are kind of key cogs in countless companies and industries on a daily basis. Its local services teams also are able to support by 17 regional distribution centers. So they're just trying, as I said, focusing on extreme efficiency at all time, and it's really been beneficial to their business. And if we look at their revenue growth over the last 10 plus years, they've posted strong revenue growth every year since 2009, when obviously the market itself just crashed. That was a financial crisis. So they posted strong revenue growth since then. In the last couple of years, they posted 16% growth last year, 6% growth the year before that, 6% before that, 7% growth before that. You get it. Really strong growth. So looking forward, we're calling for another 5% growth this year to get up to about 7.3 billion, and then another 6% growth next year to get up to about 7.8 billion in sales. And then on the bottom line, we're calling for consistent 6% growth this year in 2023, and then another 6% growth in fiscal 2024. And the company's overall earnings revisions have trended higher over the last several years, with its most recent earnings revision activity helping it land that Zacks rank number 2 buy at the moment. It also boasts a really strong balance sheet. It has about 3.1 billion in current assets versus just 668 million in liabilities. And then if we look at the total picture, it's got about 4.6 billion in total assets versus just 1.1 billion in total liabilities. It's also consistently raised its dividend. It boosted its payout by 12% or 11% in 2022, and then 13% in 2023. Its yield currently sits at 2.2% versus, say, a firm in the same industry as it's sitting in. Home Depot's at 2.3%. So solid yield, especially as earnings or as interest rates are falling. more investors are going to start looking for these dividend paying stocks again. And then overall, the stock soared about 131% in the last 5 years. This blows away its broader retail sector, which is up 42%, and the S&P 500, which is up about 90%, and its industry, which is up about 110%. Over the long haul, over the last 20 years, it's up about 950% to blow away the S&P 500, which is up just 330%, and its sector, which is up 500%, and it easily tops its industry, which is up about 700%. So really strong outperformance over the near term and over the last 20 years. In about the last 12 months, it's up nearly 30%, and it's currently trading about 4% below its recent highs, and it's finding some support at its 50-day moving average. In its recent pullback, along with the broader market, took it from heavily overbought RSI levels to roughly neutral at the moment. So maybe a solid entry point for the stock heading into earnings. And overall, it trades at a 20% discount to its highs in terms of forward earnings at 29.7 times forward earnings. So all said, Fastenal might be worth considering as part of a broader diversified portfolio. It operates a really sturdy business model, got a great balance sheet. Obviously, playing anything right around earnings is never easy, but certainly worth putting it on your watch list if you don't want to buy it just for a near-term earnings play. And now we're going to move on to another highly ranked Zacks stock that's reporting its results on January 23rd, and that is Stride Inc., which trades in the ticker LRN. Stride is one of the top tech-focused online education companies in the U.S. Its various services aim to serve K through 12 students and parents, as well as adult learners, various school districts, businesses, military, and beyond. So a huge online education platform that has a lot of different groups that use their services for all their array of offerings. It boasts that it offers everything from high-quality online and blended learning solutions to hands-on curriculum and career-oriented programs, and everything from healthcare to technology. So it's not just for school-age kids, but also helping adult learners focus on things such as learning about tech or healthcare services. It's far from just a pandemic and lockdown success story. It went public over 15 years ago, growing from around $400 million in revenue in 2010 to about $1.8 billion last year. And it's delivered millions of courses to students across the U.S. and over 100 countries. Obviously, the COVID-19 pandemic massively boosted Stride's revenue and earnings as more families and people realize that online education is kind of an invaluable supplement and even sometimes a primary education tool, and it could continue to grow going forward. Stride's revenue climbed 9% in fiscal 2023 and 10% in it's 2022 after soaring 48% in fiscal 2021, which is obviously that big COVID boost. The company crushed our Q1 FY 2024 earnings back in October and provided upbeat guidance, as it said it benefited from its career learning segment and also especially from the middle to high school cohort, as people are looking to kind of get into some trade school environments instead of possibly going to those longer term college programs after college. Or after high school, I should say. Zacks estimates are calling for its revenue to climb another 9% this year and then over 6% higher next year, with its adjusted earnings expected to soar about 35% this year and then another 13% next year. And it's crushed our bottom line estimates over the last 4 quarters, and as I said, including that big beat last quarter. And overall, its earnings revisions activity has trended really steadily positive over the last several years, and then most recently, the post-earnings release upbeat activities helping it land a Zacks ranked number 1 strong buy at the moment. And its shares are up about 150% in the last 3 years to blow away the S&P 500, which is up about 25%. And this includes a massive post-earnings release spike that helped it finally break out above its 2020 highs. It's trading heavily above its 50-week moving average, and it's now trading slightly below its 50-day moving average, as it went from way overbought to now getting close to oversold. So we could see some more selling in the near term, but it's still trading at a 15% discount to its average Zacks price target. And then on the valuation front, it's trading nearly 80% below its highs at 13.5 times forward earnings and 44% below its 10-year median. So its earnings are trending in the right direction. It could see more near-term selling along with the broader market. So maybe you want to wait until after the company's reports if people either take profits based on a good report or a bad report. If you don't want to play, as I said, playing just around earnings is always very risky. But if you want to put it on your long-term watch list, Stride certainly seems like a company to consider. And once again, that's ticker LRN. And now we're going to move on to a name that probably everyone knows, and that is Netflix, which trades in the ticker NFLX. And they will release their Q4 results on January 23rd. Netflix was the streaming TV pioneer. They kind of revolutionized the way that many people watch movies and TV shows, and streaming kind of remains the growth segment and is really the future of entertainment. Yet Wall Street sold Netflix stock based on wider concerns about growing competition, slowing expansion. And then more recently, but this is not much of a concern at this point anymore, were those big Hollywood strikes. Now nearly every company is a streaming TV company. Like every company in the entertainment business has some streaming business, and they're trying to all kind of compete on the price front, and they're going to start seeing packages and bundles in the near term. But linear TV is definitely going away. And it's unclear exactly what the streaming space is going to look like, but streaming is going to be what the primary mode of entertainment is. And Netflix, based on its head start and growing content library, have really maintained that edge over, say, the likes of Disney and Apple and Amazon and countless other streamers. So the company has beat our Q1, Q2, and Q3 earnings estimates. And the last two periods were really strong membership growth. So they did 8% growth in Q2, and then they did about 11% membership growth in Q3 to get all the way up to 247 million. So over 247 million paid memberships. And Disney closed last quarter, for reference, with 150 million subscribers. And its lower cost ad-based tier is also gaining steam, which is a solid sign. And it's actively kind of expanding its video game segment, which could prove lucrative in the long run. And then some of the big news today, Netflix stock was up big because their president of advertising revealed that their advertising-based plan surpassed 23 million global monthly active users, which is a notable increase from the previously reported 15 million users just a little over 2 months ago. Their president of advertising also highlighted the strong engagement levels among users on the ad-supported plan, with 85% of them streaming on the platform for more than 2 hours per day. This suggests that the ad-supported model is definitely resonating with its audience, and it could help it continue to expand its reach as that paid tier had become more saturated. And despite the growth of streaming, a lot of people still don't have Netflix. So it's good to see the paid ad-supported tier helping as well. Netflix also, they're cracking down on shared accounts. I know this is something actually my family's had to deal with recently, and setting up more Netflix plans because they're getting really strict with who is sharing their Netflix account with who. So that should help growth in the long run as well. So with that in mind, they're projected to grow the revenue by 6% this year and then 14% next year. And then the top line growth obviously marks a big slowdown from what was an average of 28% sales expansion between 2017 and 2021. But Wall Street already punished Netflix for that fading growth because they saw that they did 7% growth last year. So this is kind of already baked into the cake. And now Netflix, like many other formerly like growth at all cost tech companies, is focused on the bottom line. So its adjusted earnings are projected to grow by 22% this year, and then another 32% in 2024. And some of its most recent / most accurate earnings estimates are coming in well above consensus. So for Q4, the most recent Zacks estimates coming in about 6% above consensus. First quarter for 2024 coming in 11% above consensus. So the trending in the right direction for Netflix, and this helps it land a Zacks rank number 2 buy at the moment. The stock has blown away tech over the last 10 years. It's up still 930% versus tech's 250. It's up nearly 200% off its lows, yet it's still trading 30% below its all-time high. So that's a positive sign. It's now back above its 200-week and 50-week moving averages and trading below overbought RSI levels on that long-term scale. And it's also back above its 50-day moving average. So and about neutral RSI levels as well. So trending in the right direction above that 50-day moving average. And then, as I said, it was up big as I'm recording this on Thursday afternoon based on that ad tier based news. And then on the valuation front, it's trading at a 60% discount to its 10-year median at 29.8 times forward earnings and nearly 95% below its peak. So certainly worth considering Netflix at the moment as it still trades 30% below its highs in terms of its price, and its valuations looking enticing. And the streaming business, though it might look a little different in, say, 5 years, and who knows exactly what it's going to look like, Netflix is definitely going to be a big player in the space for years and years to come. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.